Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. In this month's LONGWave video, I'd like to discuss how a historically overvalued equity market is likely to soon shift in a secular rotation towards sounder underlying fundamentals and valuations. This will occur under the nervous eyes of monitoring central banks tasked with keeping financial markets artificially stable through the necessary adjustment. As such, I'd like to explore why this is likely and what form it may take. To do this, I'd like to cover the items shown here. As our longer-term subscribers are well aware, the financial markets no longer reflect economic reality, as they have diverged due to government policies allowing financialization, financial engineering, and the macro-prudential policies of financial repression to take a solid hold of public policy. The COVID-19 pandemic, adding only further political policy blunders, has additionally resulted in an unprecedented historic global demand and supply shock. A critical problem resulting from these policies is not just the creation of a fragile, unbalanced, and over-leveraged financial system, but the problematic and broad-based inequality in developed economies. Inequality inevitably leads to social unrest and serious governance problems for democracies. We now face critical inequality levels and a loss of trust in the system. The social contract between the governing and the governed has frayed to the point of historical low levels of trust in the government, politicians, the media, and maybe most importantly, the sense that we are being led in the wrong direction. We've been talking about these themes in many prior Under the Lens, LONGWave, and macroanalytic videos, as well as the 2016 thesis paper warning of a coming crisis of trust. Before this crisis, we saw the largest wealth gap in modern history since the Gilded Age in 1870 to 1900, with the richest 1% owning more than half of the world's wealth. After the first phase of this crisis, the gap may double or even triple. Small and medium-sized enterprises are being wiped out, with the only stable jobs being with the government or with megacorporations. The public is not in the financial markets, but is in the real economy. The upper middle class and higher may hold IRAs, 401ks, while unemployed Robin Hood millennials discover day trading, but the vast majority of citizens do not. They only see the government helping those well-connected corporations and not them. The public is broke. Small businesses are failing en masse, while government money and public debt relentlessly flows to financial corporations, failed zombie industrial companies, and soon to mismanaged local, regional, and state governments. Is it any wonder we are seeing unprecedented levels of protests, riots, and looting from people frustrated by injustices and a pervasive sense of hopelessness? I have spent sufficient time in prior videos and newsletters on the profound changes COVID-19 has ushered in to the global economy. What now looms is the fallout from a global demand and supply shock and its impact on corporate profits and solvency. All of this is certain to trigger a protracted global recession marked by minimally 12 months of negative growth, with economic and social displacement the likes of which the world has never seen before. The decision by countries like the UK, France, Italy, Canada, Australia, New Zealand, and the US to voluntarily implode their economies and place most of their populations under house arrest will have a lasting impact not only on national economies but also the global economy for years to come. In terms of scale, the damage caused to markets and industry has already surpassed the 2008 financial crisis by orders of magnitude, and frankly, there's no end in sight. To fight the coronavirus, governments have imploded their real economies and replaced them with nationalized pools of finance earmarked for specific sections of the economy. This emergency transformation is the same as a wartime mobilization of an economy, with a heavy focus on the medical and pharmaceutical industrial complex, the military, and selected corporate partners handpicked by the state. This hard fusion of state and corporate interest is classic corporatism or frankly, just out-and-out fascism. In this brutal and constrained environment, these are going to be some of the only institutions strong enough to remain viable. The net effect of immediately putting millions of workers onto government welfare rolls and pushing hundreds of thousands of small to medium-sized businesses into bankruptcy will potentially be the largest consolidation and transfer of wealth in modern history. Similar to the 1930s Great Depression, those with enough capital to ride out the crisis will be able to buy up companies, and frankly even whole industries, for literally pennies on the dollar. Monopolies like Amazon, Google, and telecom giants will consolidate and solidify their market shares as competitors gradually die off and are swallowed up into receivership. Markets see this and are presently pushing the fangs, therefore, to inconceivable valuations. Independent contractors will now be reliant on government assistance, as will any businesses qualifying for government relief grants and loans. Large corporations can be expected to have governments covering the cost of their payrolls for the duration of this crisis. There is no semblance of any discernible sound economic model to describe what is now happening with government printing up record amounts of money to cover the enormous costs of the shutdown. For a wealthy country like the U.S., the Federal Reserve will simply go into overdrive, creating trillions of dollars to be released through various stimulus plans and bailouts. The New York Fed is now pumping trillions of new dollars into banks, with the Fed also issuing bridge loans directly to businesses. This never happened before in history. The U.S. is also buying up unprecedented amounts of corporate bonds in order to keep Wall Street afloat. With these levels of quantitative easing, there are risks of hyperinflation and other systemic problems. This may be coupled with higher food prices due to supply shortages and stagnant wages due to a glut in the labor market after the government's domestic scorched earth economic policies. As a result, all fiat currencies are in a debasement race to the bottom. The macro environment is one of global, synchronized monetary debasement. The end result of all these bailouts, if they ever end, will be exactly as with any war in history, a rapid wholesale transfer of power, control, and ownership into centralized government and the central banking cartel. Markets are no longer markets at all, or even casinos. They have effectively become clearinghouses for transfers of wealth from the many to the few. Not only have the billionaire class made money, they have tightened their monopolistic grip on the levers of money supply and distribution, turning a global rigged casino into a global company town. What basic precursors do you need to stampede wealth towards the few? You need unlimited cost-free money, preferably the US dollar as the world's reserve currency. You need dominant global corporatism and oligarchy in which all asset, valuation, production, government regulation, and monetary policy is geared to the maximum financial enhancement of a tiny billionaire elite. You need austerity and disaster capitalism for the little guy so you can force them to sell off their assets at rock-bottom prices. For individuals and families, this means your savings are wiped out, your property collapses in value, and your future prospects are dim, at least in the short to midterm, and you'll have no choice but to load up on personal and family debt to simply survive. Developed and developing countries are likely to become dependent on credit lines from either the International Monetary Fund or from the United States itself, which will have plenty of dollars in U.S. Treasury bonds for sale or loan at near 0% interest rates. Plenty of funny money to go around, mostly for the elites. The shutting down of the world's airlines, along with the biosecurity and financial stagnation hitting certain sections of global trade, will severely injure the dominant system of globalization. This will no doubt encourage already existing regional trading blocs like the ASEAN in Southeast Asia and the African Union, and leveraging their interest to create more regionalized and resilient trading networks. As physical trade and relations are codified regionally, globalization will increase in the online digital sphere and with international e-commerce, online learning, and social networking. Now, with massive economic recession marked by record levels of mass unemployment and debt, the balkanization of formerly open globalization routes combined with a new global veil over scarcity of resources, all under a broad cloak of biological insecurity, The soil is fertile for more dismantling of democracy and a rise in fascist regimes, particularly in the West. The trend was already moving in this direction before the crisis, but now will only accelerate. Historically speaking, the scene is now set for another world war, in which the winner sets the agenda for a new world order going into the 21st century. In no way am I suggesting World War III is on the horizon. We are suggesting, however, we fully expect a new Cold War to soon emerge with China and become the major news focus. Though we suggest China to be the focus, it will be, in fact, a conflict between a unipolar world led by the United States and a new multipolar Cold War led by China, but including Russia and other countries suffering at the hands of the weaponization of the U.S. dollar. The financial markets have become bizarre and only can be described as disconnected and delusional. We laid out this inevitable eventuality in this schematic we published back in 2012. Moral hazard and unintended consequences through misinformation, manipulation, malpractice, mispricing, and malinvestment could only lead to dysfunctional and delusional markets. This chart of Apple is representative of what has occurred. In blue are the technologies that created Apple's momentum flywheel. Since then, as shown in red and after the death of Steve Jobs, we see failed new innovations. It is only through unprecedented levels of stock buybacks and borrowings that it has exploded the stock higher, with the resulting $250 million bonus reward for the president, Tim Cook. What is the market rewarding? Apple surged even higher after last week's stock split to an even more obscene level, taking overall markets to new records, while breadth hit lows worse than those preceding the dot-com bubble implosion. Stock valuations historically are based on free, discounted cash flow. Clearly, this is no longer relevant when FOMO, that is, fear of missing out, takes over. In a FOMO world of stagnant economics, there is no alternative to the crowded trade. As those who have been involved in financial markets are well aware, this can all go on for longer than you can stay solvent. As we've long advocated in LONGWave videos, in the short term, markets are controlled by sentiment. In the intermediate term, by risk, and in the longer term, by fundamentals. As fundamentals worsen, risk deteriorates. Sentiment is prone to rapidly shift based on some event or failed belief. When all three converge, the resulting reversal can be cyclical, secular, or both. This is where we are now. Fundamentals and risk are as bad as I've ever witnessed, while euphoria, greed, and FOMO are as high as I've ever experienced. Something will give. It is only a matter of time. It is not my intent to suggest in this particular session when this will occur, but rather when that occurs, what is likely to happen in the markets, or maybe more importantly, what is likely to begin to precede that occurrence. Sentiment is presently built on the belief that the central banks are trapped and therefore effectively have your back. Like any false belief, it is partially correct, but fundamentally flawed. Yes, the central banks are trapped. Yes, they can be expected to keep liquidity and money supply increasing. However, the big and smart money fully realizes that though this may continue to be the case, it is the banks that translate liquidity into credit. Additionally, it is the capabilities and desires of consumers to translate available credit into debt and consumption. Central banks don't control the back end of the pipeline. Banks are now tightening credit lines, credit limits, and taking significant loan loss reserves while increasing excess bank reserves at their central banks. There are practical limitations to the rate of liquidity absorption. Tighter credit, coupled with weakening demand and consumption along with rising corporate costs, creates solvency problems which central banks are not mandated to fix, at least yet, and they will be tasked with that eventually. If it wasn't for the congressional fiscal stimulus in the form of added unemployment benefits and the payroll protection program, consumption in the U.S. would have totally collapsed. We may have weathered the storm, but only delayed the tsunami of coming layoffs, restructuring, and bankruptcies. This is the case as unpaid mortgages, rents, car payments, utilities, etc. will soon come due. Who is going to be able to pay, and how long can businesses survive with out-of-control accounts receivable and bad debts? This is analogous to the 1930s when farmers couldn't pay the banks as the dirty 30s Dust Bowls decimated farmers. It wasn't solved quickly, nor without a generation living through the consequences. We can expect in today's fiat currency regime for the global economy to be analogous to the 1930s, but not the financial markets. The markets will rotate with new sectors and leaders where safety and value can be found. After creating the wealth effect, the central bankers can't allow it to reverse, nor do the wealthy winners and well-connected crony capitalists plan to allow it to be taken from them. In the near term, it likely means that anything that maintains or augments elite wealth and increases elite options will be supported. Anything that consumes or converts common people's wealth and labor and restricts their choices will be pursued. Anything that reinforces accountability, rational response, or cause and effect will be actively suppressed. Forget reversion to the mean. When the stock market should crash, it won't, until some time frame far longer than even the most generous fundamentals will dictate. One only has to observe where the respective value wealth of each party resides and where it gets channeled to know what the markets will do and where policy will go. Analysts that try to predict their near-term market moves based on Laffer curves, Elliott waves, and historical cycles will almost definitely fail. We don't have a new era, but we definitely have unprecedented coordinated global intervention dedicated almost solely to the fortune of that top 1%. That is the new rule that will govern until there is a serious breakdown. Besides stock buybacks, a major factor supporting stock investment is stock dividend yields. Stock yields have become extremely attractive relative to fixed income in addition to their capital appreciation. Though yields can be expected to fall during recessions and slowing economic growth, we are recently seeing something quite startling. Instead of falling by 15 to 25%, which is normal historically, they're falling by 100%. Look at the drops shown here most recently reported. Boeing dropped from $8.22 per share to zero. Walt Disney dropped from $1.72 a share to zero. Scan down the list. They are major corporations across a broad array of sectors that are simply stopping all dividends. Many of these corporations have been borrowing to pay dividends, which is frankly, in my opinion, criminal. To those trying to hoard cash as credit tightens. This suggests money will soon move out of what I will refer to as the dividend class of stocks to those that have proven abilities to pay out. Often these are sectors such as utilities where revenues are a function of regulation. However, even those are seeing revenues plummet as consumers are forced to default on basic needs because of lost jobs. The relative performance chart of the Russell 1000 Value ETF, that is the IWD Top 10, and the IWF Top 10, which is the Russell 2000, and the S&P 500 show that although large cap growth has been outperforming for years, the last 6 months have proven to be extreme. The chart of the ratio of the IWD Top 10, IWF Top 10 with annotations shows that a reversal just back to the 4-year downtrend line would be a 50% rally from current levels. Historically, this would take 2 years. The table is set for more profits to be made while others take losses during a rapid rotation. The S&P 500 real earnings yield is at the lowest level in a decade. Prior lows were also the times that gold outperformed equities. In the early 2000s, for instance, the gold to S&P 500 ratio went up by 120% over 3 years. Even in 2010, a bull market for stocks, gold outperformed by 50%. The difference this time is that stocks have never been at record high valuations, with fundamentals so severely depressed. This may be a perfect time to buy gold and sell stocks. And when we say buy gold, we also include silver and precious metals in mining stocks, where there is even more upside exposure from both an alpha and a beta to a macro move up in gold. We are not giving investment advice here, only pointing out what market history suggests. Skeptics of a long gold thesis often say real yields can't move any lower. This is often because they are looking at the TIPS market, which only dates back to 1997, and real yields are already at their lows for this time frame. Therefore, some investors assume interest rates, when adjusted for inflation expectations, have never been lower. That, unfortunately, fails to include one of the most important analogs to today's setup, the decade of the 1970s. Back then, 10-year yields, less inflation measured by CPI, twice reached as low as about negative 4.9%. Those moments of large and declining negative real interest rates drove two of the U.S.'s most significant surges in gold, silver, and precious metals mining stocks in U.S. history. In today's conundrum, corporations and governments are historically indebted and can't take higher nominal yields, ensuring that strong monetary stimulus is here to stay to drive real yields lower, just like Jay Powell has promised. A major narrative shift is underway. The old times of precious metals being perceived just as a haven assets are probably over. With $15 trillion worth of negative yielding bonds, record overvalued stocks, and a historically leveraged global economy, investors will likely begin to look at gold and silver, especially mining companies, with a fresh pair of eyes for both growth and value. Precious metals are the only industry where we are seeing strong and sustainable growth in revenue and future free cash flow at still incredibly low valuations today. Investors are starting to take note. Silver mining stocks, for instance, are starting to outperform even the market darlings, the tech stocks. There is a possibility that this is the beginning of a new era for precious metals. Slowing economic growth is not good for industrial usage commodities. However, soft commodities in the form of food, grains, and agriculture are a different story. Investors searching for value and safety may soon find this area to be a highly attractive area for a rotation play. Again, we are not giving investment advice here, just pointing out major historical distortions that suggests are often corrected at some point and in what fashion. We believe markets are headed higher, but they never go in a straight line. Scares, overreactions, and corrective consolidations are to be expected and to be taken advantage of. The central banks are trapped. Just something for you to think about. As I always remind you in these videos, remember, politicians and central banks will print the money to solve any and all problems until such time as no one will take the money or it has no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. The powers to be are now effectively trapped by policies of fiat currencies, unsound money, political polarization, and global policy paralysis. I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments often are, there has seldom been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2020 turn out to be an outstanding investment year for you and your family. And I sincerely thank you for listening.